Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to interim income statement and tax estimate with a Q1 loss. In other words, a loss happened in the first quarter. We're going to be making estimates looking at the interim period for the second quarter. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. If you would like to follow along in OneNote, and it's not required to do so, but if you have access to it and would like to, then we're going to be in the 1323 section in the interim income statement and tax estimate with Q1 loss. We're under the problem presentations section. Closing this back out then. I'm going to actually go down this time and look at what we're going to be creating in terms of the tables. Then we're going to go back up here. We'll take a look at all the information at once, then pull pieces of this information as we work through the practice problem. So I'm going to scroll all the way down to the actual worksheets and just look at the names of the worksheets of what we will be creating. So we're looking at Q2, and we're going to be figuring out this information as of the end of the second quarter. We have the estimated effective annual tax rate that we're going to be calculating as of the end of the second quarter. So if we read that, we got the estimated effective annual tax rate. So we're looking for an effective annual tax rate that we can then apply on a quarterly basis. So we're going to make that calculation. Then we'll do a computation of the ending inventory that we'll have to do within our worksheet. Then we'll take a look at the income statement for the 3 months ended June 30th, which is going to be the second quarter. So we're looking at the second quarter. We're in the second quarter. In doing so, we're going to have to calculate the taxes. And to calculate the taxes, we're going to have to take into consideration the first quarter. So we'll take a look at a worksheet like this, and as we do so, we'll see that there was a loss in the first quarter and see how that affects us when we do our calculations for the second quarter. All right, knowing that, let's go back up. Let's read through all the information first. Then we're going to take a look at components of that information as we work through the problem. We're going to be looking at an interim income statement and tax with a Q1 loss, the Q1 or quarter one loss before taxes. So this is the quarter one loss. We're going to be working in quarter two. So what already happened in the prior quarters, we had a $115,000 loss in Q1 the first 3 months. In Q2, the sales were $1,225,000. Q2 purchases were $675,000. The operating expenses for Q2 quarter two alone, $343,000. We're going to be using the first in, first out method was used for the inventory method. Inventory at the end of Q1 last quarter reduced to lower of cost or market. So we had a lower of cost or market adjustment for it. And inventory for reduced, and the reduced by was reduced by $23,000, and it was reduced to then the $99,000. That would be the ending inventory for the prior year and the beginning inventory, or the prior quarter, prior period, prior quarter, and the beginning for the current quarter then. But then in Q2, replacement costs recovered, and by the end of the period, market value, that should be. There it is. I totally fixed it there. Anyways, value exceeded the ending inventory cost by the $21,000. So then ending inventory estimated using gross profit method. So the gross profit method, we're going to have to take that into consideration. This up here, this little piece will be a little quirk in our problem. We'll see it, and it's not going to be the major focus, but it'll be a little quirk. And this will be a little bit difference too, a little bit of a difference twist in our problem, where the ending inventory estimate using the gross profit method, estimated gross profit is going to be 46%. Then we have the Q1 effective annual tax rate. So the effective annual tax rate that was calculated for the first quarter. So we had to figure out kind of the tax impact in the first quarter, and we had to do that estimate that we're going to do now in the second quarter. So we came out to 45% in the first quarter. We're going to come out to something different this quarter because, of course, it is an estimate. We have expected annual income at the end of Q2. So this is what we expect the annual income to be, the net income for the annual net income on the year as of now, which is currently the end of the second quarter. So we're in the end of the second quarter. This is what we expect the annual income to be as of the point in time that we're estimating the second quarter. Expected tax credit, $15,000. So this is going to be a tax credit we're going to have to take into consideration. That's on an annual basis. Dividends received deduction. This is going to be a deduction that will differ from the books to the tax return. So it's a permanent difference we will have to deal with. Then the federal and state tax rate, we say is 40%. So that includes both federal income tax, state income tax, and that rate is on the taxable income. We're speculating taxable income. and then considering the rate that would be on the taxable income. And we're going to have to adjust that so that we can apply some type of rate to our quarterly income, which is basically on a book basis that will take into consideration the differences for the tax in book, as well as like the credits that will be involved. So we'll do a worksheet on that. Tax benefits from operating losses are assured beyond a reasonable doubt. So there should be a benefit from the loss. What happens when you have a loss, right? You're not going to be paying taxes, but you could have a benefit. For example, you might be carrying the loss back and therefore getting a benefit from the loss. So typically how this works is you make money and then the Fed and the state take some of it from you, right? But what if you lose money? Then obviously, what happens? Does the Fed and the state give you money back for part of your loss since they're partners? Well, if you can take it against something else, typically you can. Like if there was a loss in a prior year or something like that, which is the assumption we will make here because there will be a loss in Q1 in our problem. So prior year income available for operating loss carrybacks $55,000. All right. So we're going to start off with an estimated effective annual tax rate as of the end of Q2. So let's read that one more time. It's an estimated effective annual tax rate. So we're looking for some type of tax rate that's an annual tax rate that takes into consideration all of the things that the normal tax rate doesn't take into consideration. Normal taxes is going to be on taxable income, doesn't include the credits in the tax rate and the differences between the book and the tax. We want a tax rate that we can then just take and apply it then on a quarterly basis. So this is how we're going to deal with that to do this process. We're looking for a rate then that we can then take and apply then on the quarterly, basically net income. So let's work through this. We will start off then with income from continuing operations. This was given to us in the practice problem, so I'm going to scroll down to the data that's a little bit smaller down below. So I'm going to keep on going down here to pick up the data if it's from the data set. So we have this expected annual income at the end of Q2. So this is the expected annual income, an annual net income at the end of Q2. So it's an annual income, 12 months that we're expecting, and we're estimating as of the current time frame, which is currently the second quarter. And then we're gonna start there. Then we're gonna take our dividends received deduction. In other words, we're gonna take our differences, in this case, a permanent difference here, to get to our estimated taxable income. That's $75,000, of course, coming from our data as well. So we had the data down here saying that there was a $75,000 dividends received deduction. So dividends received deduction that is not on the books, but is going to be on the taxes. Therefore, that we're going to take our book estimated income and subtract the $75,000 and then get to the $535. We're going to say that's the estimated taxable income. So that's what we expect our taxable income to be. We're then going to apply out the rate that would be applicable from a tax basis standpoint. And we're going to include in that rate both the state and the Fed. So Fed and state tax, 40%. That's given to us in the problem here, federal and state tax rate. So that's going to be applied to the estimated taxable income. We're looking for a rate that we can basically apply to the top line number, the net income, because then if we could do that, we can apply it to the interim net income as well, which is our goal. So we're going to say then the estimated tax before credits is going to be that $535,000 times the 40%, or the $214,000. Then we have the business tax credits, which was given at the $15,000. If we scroll down, we have the $15,000 down below that was given here. Expected tax credits. Notice that tax credit is not included in the rate. We would like to have some kind of rate where it basically includes the credit so that we don't have to try to figure out the credit on like a quarterly basis or anything like that. So then we're going to say the estimated income taxes are after the credit, the 214 minus the 15 is the 99, the 199. And then we're going to calculate our estimated effective tax rate. So we've got the estimated income taxes now. We're going to take that. I'm going to pull out the trusty calculator here. It's in the wrong screen right now. I'm pulling it down. We're going to take this 199,000, divide it by, not by taxable income, but all the way back up top to the income from continuing operations, the book income, divided by the 610,000. And that's going to give us a rate then here about 62.62 that we could apply then in theory to simply the top line number. That's what we want. We want to be able to say, well, what could I get on a number that I can just take that 610000 times the 0.3262 and get to an estimate about rounding difference about the tax. Because if I could do that, and that will include then in that one percentage number the effect hopefully of the tax credit and the difference between the book and the taxes, and I can then use that to apply on an interim basis. So that's what that's our goal now. So then we're going to scroll down. We're going to do a computation for the ending inventory. This is a little kind of quirk that we had in this particular problem, that we're going to be adjusting the ending inventory because the ending inventory estimate is estimated using the gross profit method. And so we'll have to do this little adjustment here. So we're going to say this is basically the cost of goods sold calculation. So we got the beginning inventory, which we saw down here was adjusted. It was reduced to, due to the fact that we had the lower of cost or market adjustment, down to 99,000. And then we had purchases of the 675,000 cost of goods sold formula here, just straightforward cost of goods sold formula. There's the 675,000 given to us in the data for Q2 cost of goods sold. We're looking at the current quarter now, Q2. That gives us the available for sale, the 99,000, the 675,000, adding up to the 774,000. We then have the estimated, we're kind of reversing now the last two numbers, meaning we're not looking at ending inventory here. We're looking at the estimated cost of goods sold. So we're going to end up at the ending inventory. And we're going to calculate this, we're going to see here that the ending inventory estimated using the gross profit method, estimated gross profit was 46%. So what we're going to do is we're going to take the sales, considering we're looking now at the cost of goods sold, which is going to be the opposite side of that. It's going to be 1 minus the 46%. So in other words, I'm going to take, all right, if I was to do a formula, it would be 1 minus 0.46, which is 0.54, times the 11225, well, not, there's only one. There's only one, not, okay, 1225000. And that's going to give us the 661.5. So there's the 661.5. If we then take the 774,000 minus 6615, we get to our 112,500. So there's the 112,500. Next, we're going to start to look at our income statement for the 3 months ended June 30th. So we're looking at the second quarter, so the information for the period of the second quarter. We're going to start off with the sales. So we have the sales of the 1,225,000. We got our data up top or down, actually just up top now. We got our data up top. So we're going to go up top and we're going to be saying that there is our 1,225,000. Next, we're going to be picking up the cost of goods sold. We're going to do our calculation for the cost of goods sold. Once again, this time just a straightforward calculation, but we're going to have a little quirk, a little difference that we'll have to put in place due to the fact that we had that lower cost of market adjustment. That's just a little, again, a little quirk in this problem, little change. So we had the beginning inventory. I'm just going to pull this straight from our calculation up top. Beginning inventory plus purchases. That gives us the goods available for sale. Then we're just going to adjust the bottom numbers here. So these three top numbers are the same. Beginning inventory plus purchases gives us the goods available for sale, 99,000, plus the 675,000 is the 774,000. Then we subtract out the ending inventory, which again was given to us up here, 112,500. That would normally give us the cost of goods sold, but we're going to have a subtotal here due to the fact that we're going to have the recovery from the lower cost of market adjustment. And that's going to be due to this item where we had the FIFO inventory method was used. The inventory at the end of Q1 last quarter was reduced to the lower cost of market, reduced by 23,000. And then it was reduced to then the ending inventory at the end of Q1 and the beginning inventory for Q2, 99,000. But then in Q2, replacement costs recovered, and by the end of the period, market value exceeds the ending inventory by 21,000. So we're going to have this adjustment then for the recovered from lower cost of market of the 23,000. So then the 661,500 minus the 23,000 gives us the cost of goods sold of the 638.5. So we're at the 638.5. Gross profit then calculated as the 1,255,000 minus the 658.5. So that's going to be our gross profit. Then we've got the operating expenses that's given to us in the problem. So we had the operating expenses up top being the 343,000. So 343,000 taking out the operating expenses gets us to the income before taxes. Then we need to calculate the tax. We're going to have to calculate the income taxes, but to do so we cannot just take that 243,500 times the rate that we came up to up top, the 32.62, which we would like to do because it's in the second quarter now, and we have to take into consideration what happened in the first quarter. So we'll go to our worksheet then down below here to do that. So here's our worksheet. We've got the income before taxes, we got the period, current period, year to date, estimated effective annual tax rate, and then the tax or benefit year to date, less previously provided, and then reported in this period. All right, so first period, we're going to start with Q1 last quarter. So this would presumably already be filled out. You know, if we were doing this in practice, it would already be in the worksheet. Q1, we had the loss of $115,000, as you can see here. Year to date, $115,000 loss, because that's all that has happened up until this point. The effective annual tax rate is 45%. In other words, we did a calculation, the estimated effective annual tax rate, we did a calculation. I'm going to scroll up and just to look at it. We did a calculation like this one in Q1 and came up to a different percent, that being 45% last time. So I'm going to go down and say, all right, so that's the best estimate we had at the end of Q1 for the estimated annual tax rate. And then we took that 115,000 times the 0.45 and we got the 51,750. But what is that 51,750? I mean, you know, normally we owe taxes. Like, we lost money. Does that mean the government's going to pay us? Well, it would, but usually we have to take the loss against a benefit. So if we had income in the prior year, then possibly we can carry the loss back, which most likely, you know, could quite possibly be the case, and then we would get the benefit. So the question is, do we benefit from that? And if you could carry it back, which is typically a case in the law, then you would think you would benefit, and therefore you would have a tax benefit instead of instead of an income tax. You know, it would be not a good thing normally. So then we're going to have that will just pull over to the reported in this period, and then we're going to go to the second period where we're going to pull the 243.5. So the 243.5 was what we calculated up top. That's where we're at on the income statement. The 243.5 is our income before taxes for Q2, and then we're going to calculate what's going to be the income as of the first two quarters. So in other words, we had income in Q2 of the 243.5 and a loss minus the loss in Q1, 115,000. Therefore, year-to-date income at this point is a positive 128,500. Then we're going to apply our estimated effective annual tax rate, which is the 32.62, which we calculated up top. So once again, that is the estimated effective annual tax rate that we can now apply to where we are to this year to date. This is our best estimate year to date. So that's why we want to apply it to everything up until this point. We don't want to apply the 45 because that was our best estimate as of the first quarter. We want to apply this 32.62 to the entire income year to date at this point in time. So that's why we've got 128,500 year to date times 128,500 times the 0.63262 gives us about 41,920. There's rounding because the rate is not actually 32.6. It's a little different, but it's rounding. This is an estimate, so a little rounding will not be bad in an estimate typically. And then we've got the 41,920, and then we had the last period where we had a benefit. So this time we have a tax, and last period we had a benefit. So that means that in this period, we're going to have to basically, add them up, or, we got the 41,920 plus the 51,7, and that's going to give us the 93,670. So the current period then is going to be this 93,670. So we got the current period 93,670 is going to go up top, and then we're going to get to our net income then is going to be the 243,500 minus the 93,670 to get to that 149,830.